Zero. That's how much of your paycheck my bank is legally required to hold in reserve the second it lands in your account. Not 10%, not 1. 0. Current Federal Reserve policy, in writing since 2020. I found that out last Tuesday after 9 years of processing payroll for 640 people at Bennett Industrial. $1,660,000 every 2 weeks through my hands. I read the regulation 3 times because I assumed I'd misunderstood it. I hadn't. So this week, I found out what actually happens to your paycheck in the 3 days between submit and deposit, because it turns out almost nobody, including me, actually knows. Quick reset, I'm John. New video every 2 days if this kind of thing is useful to you. Now, back to the 3-day gap. Here's what actually started this. Priya from Finance messaged me last week. Simple question, why does her direct deposit show up as pending for 2 days, but when she Venmos her brother rent money, it's instant? I've processed thousands of paychecks. I could not answer a 2-sentence question about my own job. That bothered me more than it should have, so I actually went and found out, not the textbook answer, the real one. And it turns out the textbook answer is outdated anyway. I want to walk you through this exactly the way I learned it, in order, because the order is what made it click for me. Here's what most of us were taught, if we were taught anything at all. A bank takes your deposit, and by law, it has to keep a slice of it in reserve, historically 10% above a certain threshold, and lend out the rest. That's the fractional reserve system. It's in almost every economics textbook still being printed. The idea was simple. Keep enough cash on hand that if everyone showed up wanting their money on the same day, the bank could actually hand it over. It's also not how any of this has worked since March 26, 2020. On that date, the Federal Reserve reduced the reserve requirement ratio for every depository institution in the country to 0%. Not lowered it, eliminated it. That 10% rule existed for a real reason, by the way. It came out of the 1930s after depositors lined up outside banks that genuinely didn't have the cash on hand to pay everyone at once. The reserve requirement was the fix, a legal guarantee that a slice of your money would always physically be there. That guarantee is the part that quietly disappeared in 2020, replaced by a completely different system that almost nobody had explained to them. Let me make that concrete because the percentage alone doesn't land. Under the old 10% rule, if you deposited $1,000, the bank had to physically hold back 100 of it and could lend out 900. Today, that same $1,000 deposit, the bank can legally lend out the entire 1,000 the same afternoon and hold back nothing. Your bank is legally allowed to hold $0 in reserve against your deposit. The number that generations of us were taught was the safety mechanism behind the entire banking system. The reserve requirement is currently a number with nothing after the decimal point. So if it's not reserves keeping your money safe, what is? There's a real answer, and it's not the one that makes headlines. I'll show you the actual number in a minute. And it's not what protects you the way you think it does either. Reserves and capital are not the same thing, and mixing them up is exactly what had me worried for about 10 minutes before I actually understood this. Reserves are about liquidity, cash on hand for the ordinary flow of withdrawals. Capital is about solvency, the bank's own cushion of money that absorbs losses before depositors ever do. Larger banks are required to hold a minimum core capital buffer around 7% of their risk-weighted assets. Community banks target a leverage ratio closer to 8 or 9% of total assets. That capital has to be the bank's own money, not deposits, not borrowed funds, sitting there specifically to absorb bad loans before a single depositor loses a cent. Here's what that actually looks like in practice. Say a bank makes some loans that go bad, $500,000 worth stop getting repaid. That loss doesn't touch your deposit first. It comes out of the bank's own capital cushion, dollar for dollar, until that cushion is exhausted. Your money is only at risk after the bank's own money is already gone. That's the actual order of operations, and it's the opposite of what most people assume when they picture a run on a bank. And if that cushion somehow does run out completely, which is rare, and regulators step in long before it typically gets that far, that's the exact point where deposit insurance takes over and makes you whole up to the coverage limit. The capital cushion and deposit insurance aren't competing systems. One is supposed to catch you before the other ever has to. So here's the actual unglamorous truth. Nobody's watching a reserve vault to keep your money safe because there basically isn't one anymore. What's protecting you is a math requirement about how much of the bank's own money has to get wiped out first before yours is ever at risk. It's not a vault. It's a spreadsheet with a very specific regulated amount of cushion built in. So here's where Priya's paycheck actually goes. When I hit submit, that payment doesn't move instantly. It joins a batch, millions of other payments submitted around the same time, on something called the ACH network, Automated Clearinghouse. It's the plumbing behind almost every payroll deposit, tax refund, and recurring bill in the country. In 2025 alone, that network moved 35 billion payments worth $93 trillion. Nearly 9 billion of those were direct deposits just like Priya's. Standard ACH settlement takes 1 to 3 business days. That's the regulation. That's the pending Priya was seeing. But here's the part that actually surprised me. Most banks don't make employees wait for full settlement. If payday lands on a Friday, the money is typically available in the account by 9 in the morning that day, even though the underlying settlement between banks hasn't fully completed yet. The bank is fronting it, using its own liquidity to pay Priya before the batch has technically cleared, because payroll is reliable enough that they're willing to take that short-term risk. I actually called our business banking rep to ask why we don't just pay everyone through the instant rail and skip the wait entirely. She walked me through it plainly enough that I remember most of it word for word. Instant payment rails charge a real per-transaction fee every single time, with no batch discount. ACH run in bulk costs a fraction of that per paycheck. Multiply either number by 640 employees every 2 weeks for a year, and the gap stops being trivial. It becomes a real line item, one that never once got explained to the people whose paychecks are the ones sitting in the batch. Now here's where it stops being a technical detail and starts being an actual decision somebody made about your money. Compare that ACH batch to a Venmo transfer or an instant bank transfer. Those ride a completely different, newer rail built specifically to settle in real time 24/7, including weekends and holidays in under 10 seconds. The technology to move Priya's paycheck instantly already exists. Right now, it's not used for payroll because the instant rail costs more per transaction, and at the volume a company like ours runs, batch processing is the cheaper lane. Priya isn't waiting because of a limitation. She's waiting because of a cost decision made somewhere above both our pay grades and multiplied across every payday for every employee. That decision adds up to real savings for the company processing it, not for the person receiving it. Money in transit between banks doesn't just sit still. Banks hold enormous pools of funds moving through these batches every single day, and overnight, the balances they're not actively using get parked in short-term markets, earning interest, even for a matter of hours. It's a tiny amount on any single paycheck. On billions of transactions a day, moving trillions of dollars a year, it adds up to real, ongoing revenue for the institutions sitting in the middle of that flow. This is the same short-term lending market banks use to borrow from each other overnight when they need cash fast and to quietly earn a little extra when they don't. Your paycheck for a few hours is part of that pool. One deposit among millions, moving through a system built entirely around never letting money sit idle. Scale that back up to where we started. 640 paychecks, $1.66 million, twice a month from one mid-sized company. On its own, a few hours of float on that is a rounding error to any single bank. Multiply it by every company running payroll in the country, every single payday, and rounding errors turn into a permanent, ongoing revenue line. None of this is a scandal. It's not hidden. It's just never explained to the person whose paycheck is doing the sitting. Nobody at the bank is doing anything against the rules. The rules were just never written with an explanation attached. Priya's paycheck isn't stuck, it's working. Just not for Priya. I don't say that to make anyone angry at their bank. I say it because the money is pending and the money is currently generating revenue for someone else are two very different sentences, and only one of them is actually true. 4 things worth knowing, and none of them are complicated. First, ask your own bank if they offer early direct deposit. Many do, for free, and it can get your paycheck to you up to 2 days sooner without changing anything else about your job. Second, check your bank's actual posting cutoff time, not just the payday date. 2 banks can advertise the same payday and still post the money hours apart, depending entirely on their own internal cutoff. Third, none of this changes whether your money is safe. Deposit insurance covers up to $250,000 per depositor, per bank, regardless of reserve ratios or settlement timing. That protection hasn't moved. Fourth, the next time a transfer takes longer than you expect, it's usually not a glitch. It's a cost decision, made upstream, that nobody bothered to explain to you. Now you know what to ask. I ran every one of these numbers past our own banking relationship manager before putting them in this video, specifically so I wasn't guessing at how any of this applies to the people actually watching. I told Priya all of this over lunch, and her first question wasn't about the delay. It was, so what else is happening to my paycheck that I don't know about? Fair question. There's a second number on every pay stub that most people glance past without ever adding it up. And once you do the math on a full year, it's a bigger number than the delay we just talked about. That's next. 9 years of pressing that submit button, and I genuinely thought I understood my own job. I understood the procedure. I didn't understand the system underneath it. And once you see it, you can't really unsee it. Subscribe if you want to actually understand what happens to your own paycheck before it happens to you. I'll see you in 2 days.